It is early morning in America. A delivery truck backs into a grocery loading bay. A commuter stops for gas before work. A family stares at the checkout screen and quietly puts one item back. Most people think oil shocks hit all at once. War starts, oil jumps, and by the next day, families are already drowning. But that is not usually how it works. The real danger is slower. And because it is slower, it is easier to miss. Higher oil prices usually do not crash into American households in one single blow. They move in stages. First, the market reacts. Then fuel costs rise. Then shipping gets more expensive. Then manufacturing feels it. Then food distribution feels it. Then airlines, delivery networks, and utility pressure start spreading the damage. Only after that does the full squeeze begin to show up in household budgets, inflation reports, and interest rate expectations. So the real question is not just whether oil goes up. The real question is how long it takes for a global energy shock to become kitchen table pain in the United States. And that matters right now, because the American economy is still deeply sensitive to energy, even when people think it is less oil-dependent than before. Yes, the U.S. produces a lot of oil. Yes, the economy is more diversified than it used to be. And yes, services and technology now make up a much bigger share of economic output than in the past. But none of that means families are protected. Oil still matters because energy is buried inside almost everything. It moves trucks. It powers logistics. It affects airline tickets. It shapes diesel costs. It influences farm inputs, chemicals, plastics, packaging, and the cost of moving goods across the country. Even when the average family is not buying crude oil directly, they're still living inside an economy built on systems that depend on energy costs. That is why oil shocks are so deceptive. At first, they look like a market story, a geopolitical headline, a trader story, a chart on television. But for regular Americans, that is only the beginning. The real story starts when higher energy costs begin moving through the everyday economy. And once that pass-through begins, it can change everything. Inflation relief gets harder. Fed policy gets harder. And the basic cost of getting through the month gets harder. When war risk rises in a major oil-producing region, markets do not wait for physical shortages to fully appear. They react to risk first. That is the first thing people need to understand. Oil prices can jump not only because supply has already been lost, but because traders believe supply could be disrupted. Shipping routes could become more dangerous. Insurance costs could rise. Governments could respond in ways that tighten the market even further. In other words, oil often reprices before the real-world shortage fully arrives. Then comes the second layer. Refiners adjust. Wholesalers adjust. Transport companies adjust. Businesses across the supply chain adjust. Some have contracts. Some have inventories. Some are temporarily protected. Some are exposed much faster. That means the impact does not hit every part of the economy on the same day. Gasoline can respond relatively quickly because consumers see prices at the pump in real time. But many other costs move more slowly. Shipping contracts take time to reset. Businesses often absorb part of the increase before passing it on. Retailers may delay price hikes until inventories turn over. Manufacturers may wait before repricing. Restaurants may hesitate because they know customers are already strained. So the system does not move like a hammer. It moves like a wave. First comes the commodity shock, then the fuel adjustment, then the logistics and production pass-through, then the retail squeeze, then the household squeeze. And finally, if the oil shock lasts long enough, the bigger macro consequences begin to show up in inflation numbers, consumer confidence, and monetary policy expectations. That is the real lag behind inflation. And that lag is exactly why so many people underestimate the danger in the early phase. To see the mechanism clearly, start with the geopolitical shock itself. A war, a regional escalation, a shipping threat, a supply disruption. Any of these can change expectations in the oil market. Even if physical barrels are still moving, the market starts pricing in fear. Uncertainty, possible scarcity, futures rise, risk premiums expand. Energy traders respond immediately. But families do not buy crude oil. They buy gasoline, diesel, airline tickets, groceries, consumer goods, and services that depend on transport and energy-intensive production. Before the family feels the shock, the system has to translate crude into usable fuel and then spread that cost through the economy. That is where timing matters. Gas station prices can rise fast because gasoline is closely tied to wholesale fuel markets, refining conditions, taxes, and local competition. Americans see this first because the gas station sign is public, visible, and emotionally powerful. When drivers see that number rise, it feels like inflation is already back, even before the full inflation effect has spread into the rest of the economy. Then comes diesel. This is one of the most important channels in the whole story, and one of the least understood. Diesel powers freight. It matters for trucking, rail-linked systems, industrial transport, agriculture, construction, and supply chains across the country. When diesel gets more expensive, the cost of moving goods rises. That means products arriving at warehouses, stores, and distribution centers become more expensive before they even reach the shelf. Then businesses face a decision. A company dealing with higher fuel, shipping, packaging, and production costs has only a few options. It can absorb the hit and accept lower margins. It can try to cut costs somewhere else, or it can pass the increase on to the customer. At first, many businesses try not to raise prices immediately. They know consumers are sensitive. They know demand can weaken. They know higher prices can drive people away. But if the oil shock lasts, that hesitation begins to fade. What starts as a margin squeeze becomes a pricing decision. And once enough businesses make that decision at the same time, the oil shock stops being just an energy story. It becomes a broader inflation story. That is when the household budget effect turns personal. The first visible hit is often gasoline. More money goes into the tank, which means less money for food, less money for savings, less money for entertainment, less money for debt payments. Then other categories start moving. Delivery costs creep higher. Travel gets more expensive. Some grocery items rise because transportation and input costs have changed. Household goods become less affordable. Small price increases begin showing up in multiple places at once. And that is how families often experience inflation most painfully. Not always as one giant shock, but as a series of smaller pressures that steadily erase breathing room. Then comes the psychology effect. If oil rises sharply and stays high, consumers begin expecting higher prices more broadly. Businesses begin expecting higher costs. Workers begin feeling that their paychecks are losing purchasing power again. And that matters, because inflation is not only about current prices. It is also about how households and firms behave when they believe more price increases are coming. This is where the Federal Reserve problem gets harder. If headline inflation starts rising again because energy is feeding back into the system, the Fed faces a narrower path. Even if policymakers believe the oil shock is external, even if they know it was not caused by excess domestic demand, they still have to worry about second-round effects. Will higher energy costs spill into broader prices, into inflation expectations, into wage behavior, into overall financial conditions? That means a geopolitical oil shock can delay rate cuts. It can keep borrowing costs higher for longer. Or, at the very least, it can make the central bank more cautious. And when that happens, the pain does not stop at the gas pump. It reaches mortgages, credit cards, auto loans, business investment, and the general financial mood of the country. So when people ask how fast higher oil prices hit American families, the real answer is this. Two speeds. Some of it hits fast. The gas station is the early warning sign. But the deeper inflation damage takes longer. It moves through freight, margins, retail pricing, household expectations, and monetary policy. That is why the lag matters so much. By the time the full damage is obvious, the mechanism may already have been running for weeks, or even months. For regular Americans, that means the first pain is often not the full pain. A family may first notice that filling the car suddenly costs more. That feels manageable, at least at first. Maybe it is frustrating. Maybe it cuts into discretionary spending. Maybe it means fewer restaurant meals. Maybe it means less flexibility at the end of the month. But if higher oil prices persist, the pressure spreads. Commuting gets harder. Delivery-heavy purchases get more expensive. Travel becomes less realistic. Food budgets tighten. Small businesses serving local communities face rising operating costs. And households carrying credit card balances become even more vulnerable. Because every extra dollar spent on necessities is a dollar that cannot go toward reducing debt. The emotional effect matters too. When families feel that basic mobility is becoming expensive again, confidence weakens. People get cautious. They postpone purchases. They pull back on spending. They stop thinking only about this week's gas bill and start worrying about whether the next few months are about to get harder across the board. That is how oil shocks can hit household behavior before they fully hit every inflation report. The mood changes first. The budget adjustments begin next. Then the broader pass-through becomes harder to ignore. Now, there's an important counterargument. Some people will say the United States is not as vulnerable as it used to be because it is a major energy producer. And there's truth in that. America is not in the same position it was decades ago. Domestic production does provide some cushioning. The economy is more resilient than a simple import-dependent model would suggest. But that still does not mean American families are protected from global oil shocks. Oil is globally priced. Even a country that produces a lot of energy still operates inside an international market shaped by risk, shipping, refinery capacity, investor expectations, and global price formation. Domestic production can reduce some vulnerabilities, but it cannot erase pass-through effects for consumers. Another common misread is this. If inflation data do not jump immediately, then the shock did not really matter. That is misleading too. The lag is the point. A shock can be economically real before it is fully visible in headline CPI. It can already be affecting fuel, freight, margins, business planning, and household psychology, long before the official inflation picture fully catches up. So the absence of immediate full-blown inflation is not proof of safety. Sometimes it is simply proof that the transmission process is still underway. What happens next depends on three things: how high oil goes, how long it stays there, and whether the shock remains contained to energy or spreads more broadly into freight, consumer prices, and inflation expectations. In the best-case scenario, the geopolitical scare fades. Supply disruptions remain limited. Oil retreats, and the pass-through to households stays partial. Gas prices rise for a while. Confidence takes a hit, but the system avoids a larger second-round inflation problem. In the middle scenario, oil stays high long enough to keep fuel and logistics costs under pressure. Families feel it at the pump first, and then across a wider set of everyday costs. Inflation progress slows. The Fed becomes more cautious. Households do not collapse, but they do feel squeezed again. In the worst-case scenario, the shock lasts. Shipping risks deepen. Energy costs stay elevated, and businesses across the economy begin passing through more of the pressure. At that point, the story stops being about oil alone. It becomes a renewed inflation problem, a consumer stress story, and potentially a higher-for-longer interest rate story, all at once. And that is why this topic matters so much. Oil shocks do not just tell us something about war. They tell us how fragile everyday affordability can become in a system where energy still sits underneath almost everything. So if you want the simplest answer to the title of this video, here it is. Higher oil prices can hit American families quickly at the gas pump. But the real inflation damage usually arrives with a delay. And that delay is exactly what makes the risk so dangerous. Because while households are still telling themselves the shock is temporary, the mechanism may already be spreading through the economy. That is the real lag behind inflation. And that is what regular Americans need to watch next.